Welcome to XRP Economic Radar, where we track the pulse of the digital finance world to keep you ahead of the curve. Today, we are witnessing a seismic shift in the cryptocurrency markets that has every investor on high alert. Bitcoin, the industry's primary bellwether, has just crashed below the critical $60,000 support level, sending shockwaves through the entire ecosystem. This isn't just a minor dip. It's a significant rejection from the $67,000 highs we saw just last week, and the momentum is pushing south with alarming speed. If you're holding XRP or any major digital asset, understanding the mechanics of this flush is vital for your portfolio strategy. We are going to break down exactly why this is happening and what it means for the broader market stability in the coming days. The catalyst for this sudden downturn is a perfect storm of geopolitical tension and failing market expectations. Just over a week ago, the sentiment was overwhelmingly positive as rumors of a diplomatic breakthrough between the US and Iran dominated the headlines. There was significant anticipation surrounding a potential deal that many hoped would be signed by June 19th, providing a much-needed boost to global risk assets. However, that confirmation never arrived. Instead, the situation took a sharp turn for the worse as both sides clashed again, with the president issuing fresh threats of further attacks over the weekend. This geopolitical instability has effectively sucked the oxygen out of the room, leaving investors scrambling for safety as the hope for a peaceful resolution evaporated. Adding fuel to the fire is a persistent exodus of capital from the spot Bitcoin ETFs. We are seeing a dominant trend of daily net outflows as institutional and retail investors alike pull back from their positions. This shift in behavior is a major red flag because these ETFs were supposed to be the bedrock of new permanent demand for the asset class. Instead, the constant selling pressure is creating a massive overhead burden that the market is currently unable to absorb. For our community here at XRP Economic Radar, this is a clear signal that the institutional wall of money narrative is facing its first real stress test. When the biggest players in the game start heading for the exits, it creates a vacuum that usually leads to the kind of price action we are seeing right now. Perhaps the most concerning development in this entire collapse is the mounting fear surrounding MicroStrategy. Michael Saylor's firm, known as the largest corporate accumulator of Bitcoin, is seeing its stock price plunge. For the first time in 2 years, the share price has dropped below its key psychological peg of $100. As of our latest update, the stock has plummeted 10% in a single day, hitting a 2-year low of $93. This is a massive blow to investor confidence, because MicroStrategy is often viewed as a leveraged play on Bitcoin itself. When the company's stock starts underperforming the asset it holds, it triggers a wave of fear, uncertainty, and doubt that ripples through the entire crypto sector. The FUD surrounding MicroStrategy isn't just about the stock price. It's about the underlying stability of their massive Bitcoin treasury. Some market analysts are now sounding the alarm, suggesting that the company might be forced to sell at least 50,000 Bitcoin over the next few years to manage its obligations. Others are urgently calling for the firm to halt its Bitcoin purchases entirely until the market stabilizes. In a notable shift in strategy, the company has indeed begun announcing much smaller purchases while shifting its focus toward rebuilding its US dollar reserves. This pivot from buying at any price to defensive cash management is a stark reminder that even the most bullish whales are feeling the pressure of this current economic environment. You might be wondering, I hold XRP, so why does the collapse of a Bitcoin-heavy stock like MicroStrategy matter to me? The answer lies in how different investments move together in the digital asset space. When a major player like MicroStrategy faces a liquidity crunch or a crisis of confidence, it forces a massive deleveraging event across the entire market. We can see this clearly in the derivatives data from Coinglass, which shows that roughly $650 million in positions have been liquidated in the last 24 hours alone. When Bitcoin falls and major corporate backers stumble, altcoins like XRP almost always follow the downward trend as traders sell off their most liquid assets to cover margins or move to cash. The technical damage here is significant, and it's important to look at the chart to see where the next floor might be. Breaking below $60,000 is a major psychological blow that turns previous support into new resistance. This creates a heavy market feel, where every attempt to bounce is met with more selling pressure. For the XRP ecosystem, this macro-level weakness means we need to be extra vigilant about localized developments. While Ripple continues to make strides in blockchain innovation and financial regulation, those fundamental wins can often be overshadowed by the sheer gravity of a Bitcoin-led market crash. We are currently in a phase where macroeconomic headwinds are dictating the price action more than individual project milestones. Despite the gloom, there is a silver lining for those who value long-term market health. This flush is cleaning out excessive leverage and weak-hand speculators who were betting on a straight line to new all-time highs. By rebuilding US dollar reserves and slowing down aggressive purchases, companies like MicroStrategy are attempting to create a more sustainable foundation for the future. For the XRP community, this is a time to focus on the long game. The regulatory landscape and the utility of digital assets for cross-border payments remain unchanged, even if the current price action is painful. This period of volatility is a test of conviction and a reminder that the path to a digital financial future is rarely a smooth one. As we move forward, we need to keep a close eye on two things: the geopolitical situation in the Middle East and the daily flow data from the spot ETFs. If we see a de-escalation in tensions or a return to net inflows, the market could find a bottom relatively quickly. However, if the threats of further attacks continue and institutional selling persists, we could be looking at a much deeper correction. Remember these three words: data dependent. We cannot rely on hope or outdated narratives. We must watch the numbers and the news as they break. The correlation between traditional finance, represented by stocks like MicroStrategy, and the crypto markets has never been tighter, and that relationship will define the next phase of this cycle. In summary, the crash below $60,000 is a wake-up call for the entire industry. The combination of failed diplomatic efforts, institutional outflows, and the struggle of major corporate backers has created a high-volatility environment that requires a disciplined approach. Here at XRP Economic Radar, we are committed to bringing you the most accurate and timely analysis so you can navigate these choppy waters with confidence. Whether this is a temporary dip or the start of a longer correction, staying informed is your best defense. Make sure to subscribe to the channel so you never miss a breaking update on XRP and the broader crypto markets. Hit that like button if you found this analysis helpful, and share your thoughts in the comments below. Do you think Bitcoin will bounce here, or is there more pain ahead? Thank you for watching, and stay tuned to XRP Economic Radar for your next market update.